Hey guys, how you doing? It's Will Caban, and what I want to do today is I wanted to clarify some of the misconceptions about these Fannie Mae temporary requirements for condos that are ultimately designed to protect the client's interest. They're not designed to make the process more difficult. The first thing that they highlight is any full or partial evacuation of a building. So I'm going to stop right there and just say that if you live in a building where you're being evacuated because they need to update maintenance, there's probably a telltale sign that's going to be a big issue. It doesn't matter how long it is. In this case, they define it as 7 or more days, but I can tell you right now that any lender that hears the word full or partial evacuation is going to want to delve deeper into what that is. And in some cases, evacuation could be simply related to something that's not necessarily safety or structural or requiring substantial repairs. But if they find the timeline to be over 7 days or it's unknown, you can rest assured that they're going to probe into that, and it's most likely going to end up being something that's not going to be financeable, unfortunately. Now, the other thing that they're going to be looking at from a significant deferred maintenance standpoint is, does the project have deficiencies? Any defects, any substantial damage to the foundation, to the safety, structural integrity? Is it going to affect the inhabitability of the project or the improvements? Does it impede on any of the structural or the safe functioning of the property? And are any large mechanical elements, and in this case they define it, anything that's foundational, roof, load bearing, electrical system, HVAC, plumbing, all of those, is there anything that's impeding on that, or is there anything that needs to be repaired when it comes to that? And that's a really big issue, because you have to understand, from the standpoint of Fannie Mae, they're trying to put their clients into properties that are safe, right? This is not about a financing or not trying to finance on buildings that are safe. It's about not putting clients into buildings that are unsafe. Now, anything that's routine maintenance, okay, like resurfacing a roof or repainting a building or resurfacing a pool when there's no issues for that were found for water damage or leaking or anything like that, are going to be fine. But if the damage is beyond deferred maintenance, right, it's beyond the scope of just doing regular maintenance, then that's going to be an issue. Now, if the damage is also isolated to individual units, and the units are not in and of themselves affected from an integral standpoint, from a structural standpoint, from a safety and a soundness standpoint, that's not going to restrict you and bar you either. But you need to understand that even in an example that they use, water damage from one unit to another unit, or a small fire that impacts the interior of a specific unit but not the the exterior, then that's probably not going to affect the overall approval for the property. But when you start looking at and peeling things back, you're definitely going to want to get a copy of the budget. And the reason why you want to get a copy of the budget is because in most cases you can determine whether they're going to collect any assessments, any reserves, and that's going to tell you right there if there's any more information that you're going to need to ask. So when we jump into the next topic, special assessments are going to be the next topic that they're going to scrutinize. Now, you got to understand that they're looking at any current or any planned special assessments, right? It doesn't even have to be a agreed upon special assessment. It could be something that's in motion, waiting to be voted on. And even if that assessment is paid in full, they're going to scrutinize the assessment to the point where they're going to want to understand the reason for the special assessment. They're going to want to understand the total amount of the assessment. They're going to want documentation to support that there is no negative impact on the financial stability, viability, condition, and marketability of the project. I'm going to repeat that. They're going to want documentation to support that there's no negative impact to the financial stability, viability, condition, or marketability of the project. Now, what that means is we're going to have to get either an attorney's letter, an insurance letter, or some documentation from the HOA management company supporting that there's going to be no negative impact. The issue that can come up most likely is that an attorney or an insurance company or the HOA, the management company, is probably not going to want to write that letter if they feel it's going to open them up to any sort of legal issues in the future. So something like not knowing what the financial impact would be, even though it might be insignificant, may lead a management company to decide that they're not going to write that letter, or an attorney to decide that they're not going to write that letter. And in a case like that, it's going to pose issues. Now, the borrower qualification, they need to be qualified with the assessment, which is no different than what it used to be. But it has to be understood that the borrower needs to qualify with the special assessment enforced. The added kicker here is that now we're asking for financial documents that would support their ability to fund any of these repairs. And in most cases, a special assessment is designed to collect the funds for the repair. So if they don't show they have enough funds for those repairs, there's a good possibility that it's not going to get approved simply because they don't have enough funds. And again, the whole reason for collecting a special assessment is to pool all those funds together so that you repair that. In most cases, it's not always the case, but if you for instance, if you get the insurance company to cover it and it's being done, then that could be something. But ultimately, usually those things play out for a while. And something else that I wanted to touch on is the reserve requirement. So, living in Florida, you understand that reserves are probably the number one deal killer when it comes to being able to put anything less than 25% down. The requirement for Fannie Mae is that they collect, an association collects 10% of whatever the budget amount is. So as a simple example, if the association collects $1 million, they simply require $100,000 in reserve to be collected. Very simple math, but it could be very, very complicated when you actually get a budget and you're trying to determine whether a association does in fact collect enough reserves. If the reserves are not that 10% line item, then you got to look at other things, and you could exclude other things, and that's that's for your lender to do if they know how to read a budget. But ultimately, the big change here is that there's no longer going to be a reserve study that's going to allow an HOA or Fannie Mae to approve a project that doesn't collect the 10% requirement. So reserve studies in the past have been a tool that it allows a lender to have Fannie Mae review on an exception basis and approval when a condo association doesn't have the 10% required reserves. And the reason why that's important is because sometimes a reserve study will show that the association has enough cash or doesn't have the requirement to collect any cash for the purpose of reserves, because the association may have had the repairs done, or it's a newer association, and the life expectancy for a lot of the things that reserves would traditionally cover are substantial, and they don't need any of those funds. So now going forward, that is no longer going to be the case. So reserve studies are no longer going to be something that we can move forward with in terms of getting exceptions for reserves. The other item is the project eligibility waivers. And project eligibility waivers are something that used to be issued for a certificate of occupancy. When there was a 40-year certification that was just right around the corner, and the client was closing close to that period, and they didn't have the 40-year certification completed, you would go in and you'd ask for a project eligibility waiver. And in most cases, the associations would have to provide additional documentation to support that. There's no large assessments that are going to impede on any of the 40-year certification, or they have to review the inspection. And Fannie Mae would go in, and based on the information that was provided, they would go and provide an exception waiver. And this was a common practice. But the truth is with all the things that have happened, those are things that they're no longer going to entertain. And I'm not against this. I mean, the truth is that I'm not against this. If you want to buy a condo, you want to make sure that you're buying in a building, in a unit that's going to be sound, it's going to be safe, and you don't have any issues. So we talk about the best practices, and some of the best practices, some of these things are new. So you have to understand, when you're a listing agent or your buyer's agent or just a buyer in general, you're going to want to scrutinize some of the documents. So obviously you're going to want to look at the budget. You're going to want to ask if there's any special assessments. If there are special assessments, you're going to want to ask the 4 questions that I went over earlier, which is the reason for the special assessment, what's the total amount of a special assessment, and the repayment terms. Can you get the documentation to support that there's no negative impact on financial stability, viability, condition, and marketability of the project? And you need to make sure that you qualify as a borrower on the assessment payment. When you break it down, you still want to ask for the budget. You still want to ask for the condo documents, or at least many condo documents as you could. What they're looking for ultimately is to make sure that any of the special assessments, any of the deferred maintenance, any of those items are not affecting the safety, the soundness, and the structural integrity of the property. Because if it does, you're going to have issues. And those problems are going to stem deeper than just not getting approved for the building or for that condo specifically. Essentially, it's going to come down to issues related to safety. Those things are what we're going to look at. When it comes to budgets, we're looking at if there's any reserve funding. Are there any budget deficits? Are we looking at negative cash flows? We're going to want to make sure and confirm that reserves that are being stated in a budget are in fact being collected. So again, you want to make sure that you're on top of this. The other thing that's a little bit unique for this type of change is that lenders are going to be asking for inspection reports, engineering reports, and certification reports as far back as 5 years. And the reason for that is they want to identify if there was any deferred maintenance in the past, and if there was, they want to know if it was addressed. So a very important factor. When it comes down to it, there's two ways that special assessments can come up. The first is when we ask for the condo documentation. The association would tell us if there's a special assessment. If they don't, for whatever reason, it usually would come up in the appraisals report, because they're going to look at and review the condo questionnaire. They're going to call the association, and they're going to ask about special assessments. They're going to ask about deferred maintenance. So just be aware of the fact that appraisers are now going to be in a position where they're asking about any special assessments or any deferred maintenance that may impact the safety, the soundness, and the structural integrity of the property. So when it comes down to it, those are important factors to be in consideration of. And then when looking at the property, they're no longer going to discount certain things when it comes to full and limited review. So as an example, if a project comes back limited approved because they're 25% down, they're still going to scrutinize the insurance. They're still going to scrutinize the special assessments. They're still going to scrutinize the things that may impact the structural integrity. So you have to be aware of those things, and you ask those questions up front. So make sure you're asking about any special assessments. Ask about any deferred maintenance. Ask about whether there's been any litigation or any lawsuits that have used any sort of language with regards to structural integrity, safety, and habitability. And I would tell you to even go further and just ask for a case number or case numbers if the association's involved in multiple litigation. And that allows us on the lending side to go in to pull the litigation documents. And by pulling the litigation documents, we can see exactly what the case is in reference to. And you'd be surprised. I mean, in most markets, I'm pretty sure there's the crazy lawsuits, but you might have a lawsuit for the way that the parking spots are colored, right? We're trying to determine whether this is a major litigation item or it's a minor litigation item. And major litigation items, they always stem back to any structural defects or any inhabitability issues when it comes down to financing. So just be aware of that, because that's what we're looking for. We're not looking for litigation just by itself being the precursor for a condo not being approved. It is simply that we're looking for those items that would deem an association to not be approved, mainly because there's structural and safety issues. So with all that being said, I know this was a long-winded video. I'm looking at it's 20-minute plus video, but ultimately when it comes down to it, this is extremely important, especially in my market, because my market, we're dealing with condos on a consistent basis, and most markets have a highly dense concentration of condos, and we just need to be aware of what to look for, not only on the lending side, but on the real estate side and on the buy side as well, so that you're well equipped and you understand exactly what a lender is looking for, why they're asking for certain things. And although certain things may have not been asked for in the past, you could expect that certain things are going to be asked for now, and it's just the way forward. If you have any questions about anything, or you wanted to go through anything, especially when it's anything finance or lender related, please feel free to reach out to me, and I'll speak to you soon. Take care. Thank you.